If you have $125,000 sitting in an offset account, a term deposit, or super, set aside to help your son or daughter buy their first home, you are not just being a generous parent. You may be walking straight into a pension trap that can cost you more than $44,000 over the next 5 years. You have seen the numbers on the news. Median house prices in Sydney and Melbourne now sit at more than 10 times the median income. Your kids are paying rent that eats half their pay, and you have cash sitting there earning a bit of interest while they struggle. So you do what any parent would do. You think about handing it over. The Bank of Mum and Dad guides never mention this part. Under Centrelink's deprivation rules, gifting that money can trigger a 5-year assessment period that quietly cuts your age pension, fortnight after fortnight, for helping your own child buy a home you will never live in. This is not really a story about the housing crisis. It is a story about that crisis reaching straight into your retirement account, pulling money out of the fund that was meant to carry you through the decades after you stop working. Today we are going through the exact mechanism Centrelink uses to claw that money back, and the one legal structure that lets you help your kids without losing your own pension. If you are between 55 and 65 and you feel squeezed between your own retirement and your children's survival, stick around. This is the channel for people trying to protect the Bank of Mum and Dad from going broke. This is the number that actually matters. Under Centrelink's gifting and deprivation rules, you can give away up to $10,000 in a single financial year, or $30,000 across a rolling 5-year period, without it touching your pension. Go over that, and Centrelink treats the extra amount as if you still own it for the next 5 years. I've watched families do exactly this without realizing what it costs them down the track. A parent hands over a lump sum for a deposit, feels good about it for about a month, and then their pension payment drops and nobody can quite explain why. Let's put real numbers on it. Say you gift $125,000 to help your daughter buy an apartment. The first $10,000 is exempt. The remaining $115,000 is now a deprived asset. Centrelink keeps counting that $115,000 as part of your assets for the next 5 years, even though the money is gone and sitting in your daughter's mortgage account. If that pushes you over the assets test threshold, which sits at $333,000 for a single homeowner, your pension drops by $3 per fortnight for every $1,000 you are over. On $115,000, that works out to roughly $345 a fortnight, or close to $8,970 a year. Run that for the full 5-year assessment window, and you have lost more than $44,000 in pension payments, on top of the $125,000 you already gave away. Picture what that actually feels like month to month. It's roughly the cost of your car registration, your council rates, and a decent chunk of your electricity bill every single year for 5 years straight, just for helping with a deposit. It doesn't show up on any brochure. It shows up quietly on your Centrelink statement a few pay cycles later, once the assessment period is already locked in. The government's logic is simple, even if it doesn't feel fair. If you can afford to give away 6 figures, they assume you don't need the taxpayer topping up your income. They deem income on money you no longer have, and they keep counting an asset you no longer hold. But the pension loss is only half of it. The real risk is what I'd call the dependency flip. You help your kids buy a house now, your own super and savings run thinner than planned, and 10 years from now, you're the one asking your daughter if you can move into the spare room. Helping them today can quietly set up the exact situation you were trying to help them avoid. None of this means you should never help. It means the shape of the help matters as much as the amount, which is exactly what we'll get into next. There's a phrase for what's happening right now. Some people call it the 2-speed retirement. Renters and first home buyers are stuck on one speed, watching prices climb faster than their savings. Homeowners nearing retirement are on the other speed, sitting on equity built over 30 years of mortgage repayments, feeling pressure to hand some of it over. The mistake most families make is treating help for the kids as a gift, full stop, no strings, no paperwork. Stop calling it a gift and start calling it what it actually is, a secured family equity interest. Same money, same intention behind it, but a completely different set of rules protecting you both if anything goes wrong down the line. I used to think that family is family, and you don't put a price tag on helping your own kids. Then I saw a 68-year-old client have to go back to work stacking shelves at Bunnings because he'd handed over money from his own super to help his son with a deposit and never structured it as anything other than a straight gift. Watching that changed how I think about this completely. An unstructured gift isn't generous. It's a risk to the whole family, including the child you're trying to help. The alternative is a legally structured family loan. It's a formal written agreement between you and your child. It can be interest-free if you want it to be. The part that actually matters is that it's a loan, not a gift, which changes how the money is treated if things go wrong, whether that's your own pension assessment or a family law dispute down the track. None of this requires a complicated trust structure or expensive advice, just a document that matches the size of what you're actually handing over. There's a trade-off nobody spells out. A loan agreement takes an afternoon with a solicitor and might cost you a few $100s in legal fees. Skip that step, and if your child later separates from a partner, an unstructured gift can be treated as shared property in a family law settlement. The money you meant for your child can end up split with someone who isn't even related to you. A secured loan, ideally registered with a caveat on the title, gives you a legal claim to that capital before it gets carved up in a settlement. If you think putting a loan agreement in writing feels too formal for family, wait until you see what happens to that money the day your child's relationship breaks down. To understand why this is hitting so many families at once, you have to look back a few years. Between 2022 and 2024, interest rates went up more than 13 times. Most of the fixed-rate mortgages people locked in during the low-rate years have already rolled off onto higher variable rates. But the real pressure point isn't behind us. It's still ahead, expected to peak around 2027. The reason comes down to two things happening at once. Employers are now paying the super guarantee at 12%, the final and highest rate under the legislated schedule, on top of wages that haven't kept pace with the cost of running a small business. Add flat productivity growth into the mix, and the businesses that employ your kids are running tighter margins than they have in years. That squeeze flows straight through to the wages and job security of the people you're trying to help into a home. Meanwhile, the number you need for your own retirement keeps climbing. According to ASFA, a couple now needs around $690,000 in super to fund what's considered a comfortable retirement, one that covers private health cover, a reasonable car, and the occasional holiday. If you drain your own balance down to $400,000 to help your kids with a deposit, you haven't just tightened your belt for a year or two. You've dropped below the line that separates a comfortable retirement from 20 years of stretching the basic age pension as far as it will go. Picture the car rego renewal or the Medicare gap payment landing the same month as a bigger grocery bill. That's what a thinner retirement balance actually feels like. Not a spreadsheet number. A string of ordinary bills that suddenly feel tight. That's the trade most people don't realize they're making when they write the check. It isn't super today versus super next year. It's a holiday and a buffer for medical bills versus decades of checking your bank balance before you turn the heater on. So before you help anyone else, the first step is stress testing your own numbers. What does your retirement actually look like if you hand over the money you're planning to give away? Let's stress test this with a scenario that isn't far-fetched at all. Picture a 15% drop in share markets sometime around 2027, the kind of correction that happens every decade or so, landing at the same time your adult child loses their job in a rough patch for hiring. Two families go into that downturn from the same starting point. Both have super balances they thought would comfortably cover the ASFA comfortable standard for a couple, which currently sits at around $77,375 a year. The first family gifted $100,000 outright for their son's deposit. When the market drops, their remaining super drops with it. They have no age pension to fall back on, because the deprivation rules are still counting that $100,000 against them. Their son, now without an income, can't help either. That family ends up selling their own home to downsize, not because they wanted a smaller place, but because they need the cash to eat. The second family used a secured loan instead. When the same downturn hits, they don't carry a deprivation penalty the same way, because the loan is recorded as an asset they hold, not one they gave away. More importantly, because it's a loan, they have a legal right to call some of that capital back if their own situation gets serious enough. Their son still owes the money either way. The difference is whether the parents have a legal path to it when they need it most. That single difference, a loan instead of a gift, is often the gap between weathering a bad year and being forced into decisions neither parent ever wanted to make. Most people spend all their worry on the assets test, checking whether they're a dollar over some threshold. The bigger threat sitting underneath it, especially once you've deprived an asset, isn't the assets test at all. It's income deeming, quietly calculating income on money you don't actually have anymore. That's the part that catches people off guard. You can watch your assets test threshold carefully your whole life and still get blindsided by a deeming rate applied to a gift you made years earlier. If you're going to help your kids, here's how to do it without setting off any of the traps we've just gone through. Step 1 is a 5-year look-back audit. Before you apply for the age pension or before you increase an existing part pension, look back over the last 5 years and add up every gift you've made above the $10,000 annual limit. If you're planning to apply for the pension in the near future, timing matters more than the amount. Even if you're not applying straight away, it pays to run this audit every year or two. Because the 5-year window keeps rolling forward, it isn't fixed to a single date. Step 2 is putting a proper loan agreement in place instead of a handshake and a bank transfer. A solicitor can draft a family loan agreement in an afternoon, spelling out the amount, whether interest applies, and what happens if it needs to be repaid early. For larger amounts tied to a property purchase, you can register a caveat on the title, which gives you a legal interest in the home itself, not just a verbal promise from your kid. Get this in writing before the money moves, not after your child has already signed a contract of their own. This isn't about distrust. It's about making sure everyone remembers the same terms years later, once the memory of the original conversation has faded. Step 3 is the $10,000 rule. If you'd rather gift than lend, keep any single gift under $10,000 in a financial year to stay clear of the deprivation rules altogether. Most people miss one detail here. If you gift $10,000 on the 30th of June and another $10,000 on the 1st of July, you've moved $20,000 in 2 days. And because it falls across 2 different financial years, neither amount breaches the annual limit. I know a contract feels unnecessary, maybe even a bit cold, when it's your own child on the other end of it. I've sat in rooms where siblings are shouting at each other over a gift one of them got and the other didn't, years after the money changed hands. A written agreement isn't a sign you don't trust your kids. It's the thing that stops a generous decision today from turning into a family argument a decade from now. There's one more barrier left, and it's not sitting in your bank account or in a Centrelink form. It's sitting in your head. Let's talk about the part most people never say out loud. This next part is harder to fix with a spreadsheet. Even after you understand every rule we've just covered, there's a good chance you'll still feel guilty about not handing over the cash. That feeling has a name. Some psychologists call it altruistic self-harm, the pull to protect your kids even when it costs you more than you can really afford. It's not a character flaw, it's closer to instinct, and it doesn't switch off just because you're 58 and reading about assets tests. If you felt guilty watching your kid pay rent on a damp one-bedroom unit while you've got a spare room and a decent super balance, that guilt doesn't make you selfish. It makes you a parent who's paying attention. Wanting to keep your own pension and your own financial footing isn't choosing yourself over your kids. It's the opposite. Try shifting how you think about it. Instead of measuring help by how much cash leaves your account, measure it by whether you stay financially independent for the next 20 or 30 years. If you go broke helping them today, you don't disappear from the picture. You become someone they need to support later, on top of everything else they're already juggling. The most useful thing you can hand your kids isn't a lump sum. It's a parent who never needs to ask them for help. Now, let's lock in the exact numbers you should walk away from this video remembering. So where does that leave you? The housing crisis is real, and your kids are genuinely doing it tougher than you did at their age. But your own retirement doesn't have to be the thing that pays for it. Avoid the deprivation trap by keeping gifts under $10,000 a financial year. If you want to help with a bigger amount, use a properly documented family loan instead of a straight gift, and get a caveat registered if it's going toward a property. Stress test your own numbers first against the $690,000 that ASFA says a couple needs for a comfortable retirement before you decide what you can actually afford to give away. If you want help thinking through the next few years without losing your own financial footing along the way, subscribe to this channel. We're focused on building a retirement that holds up, one video at a time. You worked 40 years to get here. Don't let one generous decision turn into a 20-year stretch on the basic pension.